Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Interest rates are set to rise in coming months, possibly as soon as June. Well, that has an obvious impact on homeowners, those looking to get into the housing market, and of course anyone with savings accounts. I wanted to look today at what it means for investing in equities. Chris Brycki is the CEO of online investment advisor Stockspot. Chris, welcome back to Fear and Greed.
Thanks, Sean.
Let's jump right into it. I want to go into sectors as we go along, but first up, what does a rising interest rate environment mean for investors in the local market, particularly given we haven't had one for more than a decade?
No, we haven't. I mean, interest rates rose a small amount after the financial crisis, but then were cut pretty quickly from, I think, about 2011 onwards. So Aussie investors haven't really seen a sustained rising environment of interest rates for quite a while. For investors, it actually means different things in Australia. So our share market is actually better insulated for rising interest rates than other global share markets, really because two of our big sectors in Australia, which are mining companies and banking companies, they actually tend to do quite well in a rising rate environment. For different reasons, the resources do well because typically rising rates goes hand in hand with rising commodity prices. And then banks do pretty well when rates rise because they tend to borrow in the short end, so borrow in short-term interest rates, and then lend in the long end, and they earn a larger margin when they're lending in higher interest rates. So those two sectors do well, but then there's others like real estate, as you mentioned, that don't tend to do as well.
Okay, so let's expand on the banks just a little bit. They've done really well over the last month or so. I think they're up about, on average, the big four, about 10% or something or other, easily the best of the large caps in the market. That's on the back of what you're saying, is a suggestion that their net interest margins may grow. Do you think that will keep going, or do you think it's priced in? Like, what's your take on the banks at the moment?
Well, the tricky thing is that usually information is priced in pretty quickly. And so, these higher commodity prices are priced into BHP's share price. The higher interest margins that the banks could potentially earn are probably largely priced into banks. That doesn't mean that interest rates will rise and they will be able to earn those margins. And I guess on the flip side for banks, the risk is that if rising rates cause households to hemorrhage and really struggle to pay off their mortgages, they could be facing higher bad debts as well. So there's a flip side for banks to higher rates.
Okay, and the miners, it's on the back of commodity prices, and the theory there is that rising interest rates occur when economies are growing, therefore the demand for commodities is stronger. How does the war in Ukraine play into all that theory?
Well, particularly this rising rate environment, the reason why rates are expected to raise so aggressively, and the interest rate futures market in Australia has rates expected to be 3.2% by the end of 2023, so a huge number of rate hikes. A lot of this is due to inflation and central banks really trying to curb inflation, which is getting out of control in a lot of countries. So commodity prices has been one of these drivers of inflation. You've seen a lot of the raw input prices into steel or, your copper and oil, all of these have gone up a lot. And then the Ukraine conflict has only sort of accelerated that in the fuel sort of side of things. So we've seen oil prices really rocket because of the impact that Russia has on that market and in supplying Europe with a lot of their oil and gas as well.
Stay with me, Chris. We'll be back in a minute. My guest this morning is Chris Brycki, founder and CEO of online investment advisor Stockspot. Okay, now you mentioned the property sector. The real estate investment trusts are a huge chunk of the ASX 200 and obviously a huge chunk of people investing through managed funds, that sort of thing. Is it, I always get a bit confused around REITs because, if they're inflation linked, if rents are inflation linked, it might be okay, but if they're not, it won't be okay. How do we get our head around the real estate investment trusts?
Well, so I think in our market, real estate trusts are about 10% of our market. So they're big, but they're not too big. And I think people's biggest exposure in most cases is just to their own residential real estate. Look, I see property really as it trades like, I would say, a long-dated bond. So basically, real estate gives you a series of cash flows indefinitely, and therefore people look at real estate like a bond. So what we've seen over the last couple of months is government bonds have an enormous fall, actually their biggest fall in 40 years due to the expectations of higher interest rates. And you would expect that property and REITs would follow. And in the US, for instance, we've seen home builders the sector that's involved with building houses fall 34% since the start of the year, due to them being the second derivative, or I guess the next stage of housing. The problem with housing is that a lot of the value of housing comes from the cash flows that are a long way into the future. So if you own a home, yes, you're earning some rent this year or next year, but we know in Australia rental yields are very low. They're 2.5%, or in some cases even lower. And so you're not earning a lot off that asset right now. And so you really need to be able to value what you're going to earn off that asset a long way into the future. Now, if inflation and interest rates are going to eat away at those earnings in the future, then that asset inevitably is worth less. And so I think that's how people are looking at property. They're looking at all of those rental cash flows that they're expecting 10 years and 20 years into the future and saying, well, if inflation is going to be at 3, 4 or 5%, they're not worth a lot now.
Okay. Now, the other one that people group into the real assets camp is infrastructure. So real estate and infrastructure are always thought about as real assets because they are assets, very tangible. What about infrastructure? Does that follow the same line as the REITs or not?
It does to some extent. I mean, with a lot of infrastructure, it's built into the contracts that infrastructure has, that they're often able to increase prices to counteract inflation. So in some cases, they may be less sensitive. But, really, like other assets, if a lot of their cash flows are well into the future, then they're going to suffer when interest rates are eroding those future cash flows.
Mind you, we don't seem to have as many infrastructure assets nowadays. Things with Sydney Airport being sold to the super funds and things like that.
Yeah, you're right. There's only a few big infrastructure, assets listed still on the market.
So I just want to go through some of the other sectors. Retail and both discretionary and staples. So the staples being the more the Woolworths, Coles type things. Discretionary, thinking JB Hi-Fi, those sorts of things. What about those sectors?
I mean, it really depends on the sort of environment we're going to go into, and also the impact that inflation and interest rates has on the household sector. So if interest rates rise really quickly, and right now they are expected to rise over 3% in the next 18 months, you would imagine that would really crimp households' ability to spend on everything. But obviously people still need to buy food, and food prices are going to inflate. I mean, anyone that's shopped at Woolies or Coles recently will have noticed that prices are increasing. You still have to buy food. And so if more of your household savings are going towards paying off your mortgage and buying groceries, you would expect there's probably less left over to spend at David Jones. So discretionary is likely to suffer in that sort of environment. But to what extent that's already sort of built into prices? In discretionary retail, apart from online businesses, have done pretty poorly in Australia for the last 10 years. So there isn't that much optimism built into that sector in the first place.
And we can't talk without mentioning Telstra. There's about 1 million retail shareholders out there who own Telstra, and of course lots of institutions. How do you think about the telco sector, but particularly Telstra, really?
I mean, it's one that, again, it probably doesn't have a huge impact compared to some other sectors. However, like property and like infrastructure, if it is an asset that trades based on a dividend yield, then when the dividend of the cash-free rate at the moment is 0%, then people are prepared to bid up the dividend yield of shares like Telstra. But you can imagine if people can get 3% just in the bank, then businesses like Telstra become less attractive with their current dividend yields. So you would expect there to be pressure on all sorts of companies where they're owned for the dividend yield, and they might not be able to increase prices to counteract the inflation that's happening in the economy.
Yeah. So if we just move away from the sectors, and we're not a financial advice show, if you go to Stockspot, you can get all your information from Stockspot and Chris and his team. But if we move away from what I'm trying to say there is we're not recommending anything here, but outside Australia, you said that, when we started, you said because of mining and banks, the Australian market itself may do better than some other markets. So if I'm a passive investor, I want to buy an ETF, should I be thinking about the US? Should I be thinking about Asia, Europe, Australia? I'm just wondering how all those different geographies rank with each other, I suppose.
I mean, it's a good question. So what we've seen over the last 10 years, Sean, is that the Australian share market has really underperformed the rest of the world because banks and resources have actually been a big drag in an environment of falling inflation, which is what's really we've seen since about 2011 to 2020, we really suffered. Our market, fell and went sideways and really isn't any higher than it was 10 years ago. Whereas the US share market and other markets have really powered higher due to having a bigger exposure to sectors like technology. So, there's been a bit of a reversal actually over the first quarter of 2022 because those sectors that were holding us back are finally actually helping us stay ahead of the rest of the world. And actually what we saw in that first quarter was that emerging market shares, largely because of the Russia impact, fell by 9% in the first quarter. And even global US shares fell by like 6%, but Australian shares were up by 2% in the first quarter. And so I think over the last 10 years, there has gradually been a lot of Aussie money, through ETFs and other ways of investing that have gone towards global shares and US shares. And you might start to see a bit of a reversal of that if our market starts to outperform. Certainly our advice to clients is still you should have an exposure to all countries and all sectors. It's very hard to know, when one country might perform better than another country. But certainly there's been a lot of negativity directed at Australia over the last 10 years. So it wouldn't surprise me if our market is actually one of the better performers going forward. I think where global investors have liked Australia over the last few months is also because of our geographical separation from the rest of the world. They've felt a lot more comfort investing in Australia, than Europe, where there's obviously a lot of angst at the moment, or even Asia because of the slowdown that's happening in China.
You mentioned tech stocks there, and I should have brought that up earlier in the conversation, but I always think of them often as a US-style product. What about tech stocks for the next little bit?
Well, tech stocks have become very volatile since the start of the year, really, because, more than any other sector, interest rates, and people, I don't think, understand this well enough, interest rates have an enormous impact on the valuation of tech companies. If you think about a tech company, they're generally companies with a lot of growth. And therefore, when the market is trying to value them, the cash flows that they're earning well into the future have become a big part of that valuation. So for a high growth company, the terminal value of their valuation, which is basically the cash flows well into the future, might account for 90% of the whole business value. So if that value is getting eroded because of inflation and higher interest rates, it can really pull down the valuation of growth stocks. And that's what we've seen in the NASDAQ in the US since the start of the year. I think at one point the NASDAQ was down 23% or so, and it's had a bit of a bounce off the lows. But the market's trying to grapple with, what interest rates that could be 2 or 3% higher in a couple of years could mean for valuations. So we're definitely in an environment at the moment where the market isn't valuing high growth and is preferring to value steady cash flows and the ability to protect against inflation.
Chris, thank you for talking to Fear and Greed.
My pleasure. Thanks for having me on.
That was Chris Brycki, founder and CEO of online investment advisor Stockspot. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.